The new landscape, why Michael Burry still sounds the alarm. In the world of modern finance, where information travels faster than thought and markets swing with a volatility that seems almost rhythmic, one voice continues to cut through the noise with an unsettling clarity, the voice of Michael Burry. Years after predicting the 2008 collapse, years after being ignored, doubted, and later celebrated, Burry has returned with fresh warnings about the current economic environment. But what exactly does he see now? And more importantly, why does a man who rarely speaks publicly feel compelled to speak at all? As we step into this documentary, we must first ask ourselves a crucial question: what if the next financial storm is already forming, but once again, almost no one wants to look? Today's market conditions are unlike anything investors have experienced in recent history. Surging debt levels, unprecedented government intervention, speculative retail behavior, and economic narratives built on optimism rather than fundamentals have created a new kind of financial environment, one that appears stable on the surface but shows fractures underneath. Burry, with his characteristic skepticism, perceives these fractures clearly. He sees the gap between what markets claim to be and what they truly are. But how is he so certain? What allows Burry to interpret signals that others dismiss as noise? To understand his latest warnings, we must first revisit the core of Burry's analytical mind. Burry has always believed that markets are not guided by rational analysis but by collective emotional behavior. We saw this during the housing bubble when most analysts trusted rising home prices without questioning their foundation. Burry questioned them. We saw it again during the meme stock craze, when investors bought into narratives rather than balance sheets. Once again, Burry warned that such behavior rarely ends well. Through each of these cycles, Burry reminded the world that markets are driven not by facts alone, but by stories investors tell themselves to justify risk. Now, Burry is warning that modern markets are fueled by an even more powerful narrative, the belief that central banks can fix every crisis simply by injecting more liquidity. But is that really sustainable? Can debt grow indefinitely without consequences? And if not, what happens when the world finally confronts the cost of years of artificial stability? One of the key areas Burry highlights today is the explosion of consumer and government debt. In the United States alone, national debt has reached levels once considered unthinkable, while households continue to rely heavily on credit cards and loans to maintain their lifestyles. Debt, as Burry often reminds investors, is not inherently dangerous on its own. It becomes dangerous when it fuels consumption instead of productivity. This distinction is essential. Productive debt creates long-term value. Unproductive debt delays consequences. So the question becomes, how much of the world's current debt is productive, and how much is simply postponing the inevitable? Burry's view is that we are living through a massive postponement. He believes that modern markets are fragile precisely because they rely on constant intervention to remain stable. After the pandemic, financial systems became accustomed to extraordinary support measures, stimulus checks, emergency lending programs, ultra-low interest rates, and aggressive money printing. These measures were intended to prevent economic collapse, and in many ways, they succeeded. But Burry argues that crisis interventions have quietly become the new normal. And this, in his view, is unsustainable. If markets require constant rescue, are they truly healthy? If asset prices surge only when liquidity floods the system, what happens when that liquidity is withdrawn? And perhaps the most unsettling question: have investors forgotten how to operate in an environment without artificial support? Burry observes several troubling patterns: inflated equity valuations, excessive confidence in tech growth, dependence on speculative trading methods, and a dangerous assumption that losses can always be reversed. He notes that during certain periods, investors have even celebrated bad economic news, believing it might encourage central banks to loosen policy again. This is a mentality shaped by dependence, not by analysis. And when markets begin to rely more on central bank actions than on company fundamentals, risk becomes systemic. But there is another dimension to Burry's concerns, one that involves the psychology of the modern investor. Today's investors have unprecedented access to trading platforms, real-time information, and global financial commentary. Yet paradoxically, this abundance of information has not made them wiser, it has made them more reactive, more emotional, and more susceptible to groupthink. Burry sees this shift clearly. He sees how investors draw confidence not from research but from herd behavior. He sees how speculation is disguised as strategy and how short-term conviction overrides long-term discipline. This, he argues, is the fuel that inflates bubbles. The rise of social media has only amplified this phenomenon. Narratives spread instantly, opinions become facts if repeated often enough, and emotional momentum drives markets as much as, if not more than, rational analysis. Burry has openly criticized this dynamic, reminding investors that the market does not reward enthusiasm, it rewards patience, discipline, and skepticism. But how many people today are willing to be skeptical when optimism feels easier and more profitable? Burry's greatest warnings today center on the possibility that multiple bubbles are forming simultaneously. Unlike 2008, when a single sector, housing, was the root cause of systemic failure. The modern financial environment contains a broader set of vulnerabilities: equities, crypto, real estate, consumer credit, sovereign debt, and even certain forms of corporate financing. Burry believes that when too many sectors inflate at once, the eventual correction becomes far more difficult to control. The most striking aspect of Burry's modern warnings is not just the specific risks he identifies but the pattern behind them. Burry has always studied cycles. He knows that history often repeats because human nature rarely changes. Investors still chase trends, still ignore warnings, still assume they can exit before a crash. But the cycle always ends the same way, with most people trapped in the very risks they dismissed. So Burry asks, why does each generation believe it is immune to the lessons of the past? As we close this first part of the documentary, the question we must ask ourselves is simple yet profound: what if Burry is right again? What if modern markets are not as resilient as they appear? What if the optimism that dominates financial news is masking deeper instability? And if Burry's warnings are accurate, why do so few investors want to hear them? If history has shown us anything, it is that Michael Burry does not speak loudly or often, but when he does speak, the world should pay attention. The bigger question is, will it listen this time? Cracks beneath the surface, what the data really shows. To understand Michael Burry's latest warnings, we must dive deeper into the data he studies, the numbers that most analysts glance over but rarely interpret with true skepticism. Burry has always been a data-driven thinker. Long before he became known for shorting the housing market, long before the Big Short turned him into a symbol of financial contrarianism, he was a medical student studying patterns, anomalies, and the hidden signals behind human behavior. That same analytical mindset now guides his approach to global markets. And today, the data he sees is deeply alarming. But what specifically does he see that others ignore? And why do so few investors investigate these warning signs with the same intensity? One of the key metrics Burry emphasizes is the unprecedented level of margin debt held by retail and institutional investors. Margin debt reflects how much money investors borrow to increase their exposure to the market. History has shown that spikes in margin debt almost always precede major corrections. The logic is simple: borrowed money amplifies gains, but it also magnifies losses. When markets fall, forced liquidations accelerate the decline. Burry looks at these debt levels and asks, why are investors so comfortable leveraging themselves at a time when uncertainty is higher than ever? What gives them the confidence to borrow aggressively despite increasing volatility? The answer, in Burry's view, lies in a false sense of security that the Federal Reserve will always intervene. But this belief, he warns, could be the most dangerous myth in modern finance. Investors who rely on continuous intervention forget that central banks are not omnipotent. They cannot eliminate risk, they can only shift it. They cannot stop cycles, they can only delay them. And when a cycle is delayed for too long, the eventual correction becomes more severe. Burry views the modern financial landscape as one in which risk has been suppressed artificially, creating a fragile environment that could break suddenly. He sees parallel patterns between today's markets and the periods preceding the dot-com crash, the housing crash, and even historic market collapses long before his time. But if these parallels are so visible in the data, why are they not widely discussed in mainstream financial media? Burry's answer is blunt: because most people do not want to believe them. Markets thrive on confidence, and confidence thrives on optimism. The financial world tends to reward positive narratives, stories about innovation, growth, and technological transformation. Negative narratives, especially those predicting collapse, are dismissed as fearmongering. But Burry reminds investors that ignoring risk does not eliminate it. Instead, it builds it into the foundations of the system, like cracks in a dam unseen until the pressure becomes too great to contain. A second major area Burry studies closely is inflation. While many analysts argue that inflation has stabilized, Burry sees underlying pressures that remain unresolved: rising wages, supply chain restructuring, geopolitical tension, and accelerating deficits. To him, the inflation story is not finished, it is merely paused. He believes central banks are walking a tightrope between inflation control and recession risk. If they loosen policy too quickly, inflation will reignite. If they tighten policy too aggressively, they risk pushing economies into contraction. This delicate balance forms what Burry describes as a no-win scenario, one in which every decision carries significant downside. But if policymakers are constrained, what does that mean for markets that have grown dependent on stimulus? The third area Burry highlights is consumer fragility. Despite strong employment numbers, many households face financial pressures hidden beneath surface-level statistics. Credit card balances have reached record highs, delinquency rates are rising, and savings accumulated during the pandemic have largely been depleted. Burry sees these trends as early indicators of economic stress, signals that the average consumer is struggling even as markets appear robust. He argues that when consumers weaken, corporate earnings inevitably follow. And when earnings decline, valuations built on optimistic expectations begin to crack. This is a cycle as old as capitalism, yet one that many investors today believe they can outrun. But can they? Another red flag Burry often points to is the overconcentration in megacap technology stocks. These companies have become market darlings, absorbing massive inflows and carrying disproportionate influence over major indices. But Burry asks, what happens when expectations exceed reality? When valuations become decoupled from actual earnings potential? When a handful of companies hold responsibility for sustaining the illusion of market strength? The danger, he warns, is that such concentration makes markets more vulnerable, not less. When one pillar weakens, the entire structure trembles. A particularly striking comparison Burry makes involves the dot-com bubble. He notes eerie similarities between investor behavior today and investor behavior in the late 1990s: speculative enthusiasm, belief in transformative technology, and confidence that traditional valuation models no longer apply. During the dot-com era, investors justified soaring prices by insisting that the economy had entered a new paradigm. Today, similar sentiments echo across markets: AI will rewrite everything, technology will accelerate endlessly, growth will continue without interruption. But is this mindset realistic? Or is it simply the modern version of the same optimism that fueled past bubbles? Burry's approach is not anti-technology. Rather, he questions the psychology behind investors' willingness to pay any price for the promise of future growth. He warns that even great companies can experience severe corrections when valuations become detached from reality. In his view, the bigger the promise, the bigger the potential disappointment. Beyond equities, Burry is increasingly concerned about global real estate markets. Many countries face affordability crises, high mortgage rates, and weakening demand, all while property values remain historically elevated. This combination, he argues, is unsustainable. Real estate markets cannot remain detached from economic fundamentals forever. When the gap widens too much, corrections follow. But perhaps the most troubling trend Burry identifies is the complacency of institutional investors. Hedge funds, pension funds, and large asset managers increasingly rely on complex models that assume long-term stability. These models often fail to account for rare but catastrophic events that Burry argues are becoming more likely, not less. He warns that institutions now behave much like banks before 2008, confident, data-driven, but structurally vulnerable. If institutions are underestimating risk, what does that imply about ordinary investors who follow their lead? Throughout his warnings, Burry raises a powerful question: why do markets always assume the best-case scenario? Why do investors rarely plan for the downside, especially when history shows that downturns can be sudden and severe? This psychological bias, optimism anchored in recent performance, creates blind spots that Burry views as extremely dangerous. Michael Burry believes that the risks shaping modern markets are interconnected. Debt influences consumption. Consumption influences earnings. Earnings influence valuations. Valuations influence investor psychology. And investor psychology influences everything. It's a fragile web, one that can unravel much faster than it was constructed. But if the web is so fragile, why do so many investors continue behaving as though it is unbreakable? This brings us to the next phase of our exploration, where we will look at how Burry interprets market sentiment, behavioral cycles, and the emotional patterns that often precede major financial reversals. The psychology behind the warnings, why markets refuse to listen. If Michael Burry's predictions are so deeply rooted in data, historical patterns, and structural vulnerabilities, then why does the market ignore him? Why do investors dismiss his warnings as pessimism or overreaction? To understand this phenomenon, we must explore the psychology of markets, the emotional and cognitive forces that shape decisions far more than spreadsheets or economic models ever could. Burry has always believed that markets are not mathematical systems but human systems. And humans, no matter how educated or sophisticated, are driven by biases, fears, desires, and illusions that repeat across history. One of the strongest psychological forces Burry identifies is recency bias. Investors tend to believe that the recent past will resemble the near future. If markets have risen consistently for several years, people expect them to keep rising. If technology stocks have been the biggest winners, people assume they will continue dominating. This mentality blinds investors to signs of overheating or imbalance. Burry often points to the period before the 2008 crash. For years, housing prices rose steadily. Analysts believed they would continue rising indefinitely. Banks believed homeowners would never default at scale. Buyers believed property values could not fall. But why? Because everyone was conditioned by years of upward momentum. Similarly, today's investors are conditioned by more than a decade of growth in technology, low interest rates, and stimulus-driven optimism. But what happens when the conditions that shape that growth begin to shift? Another powerful psychological force is herd mentality. Investors are naturally drawn to follow the crowd, especially when the crowd appears to be making money. This behavior is not limited to inexperienced traders. Even professional investors feel pressure to align with prevailing trends. Burry argues that herd mentality makes markets more fragile because it concentrates capital into the same ideas, the same assets, and the same assumptions. When the herd turns, it does not turn gradually, it stampedes. The rush to exit becomes unstoppable. This is why bubbles collapse so violently. Those who rush in together must rush out together, but the exit door is too small for the entire crowd. Burry asks investors, if everyone is buying the same assets for the same reasons, who will be left to buy when prices start falling? And if no one is left to buy, how quickly could those prices collapse? Confirmation bias presents another layer of danger. Investors prefer information that supports their existing beliefs and reject information that contradicts them. If someone believes the economy is strong, they will emphasize positive earnings results and ignore warnings from economic indicators. If someone believes a company will keep growing, they will highlight favorable projections and overlook rising competition or declining margins. This selective interpretation of reality creates distorted narratives that feel comfortable but are detached from underlying risks. Burry argues that confirmation bias is especially dangerous during periods of optimism because investors are motivated to downplay negative signals. They want the story to continue. They want to believe they are right. And they are often emotionally invested in their conclusions. But when belief becomes stronger than evidence, markets become irrational. A fourth psychological factor Burry observes is the illusion of control. Investors often believe they can predict, time, or manage risk better than they actually can. They believe sophisticated data models, algorithmic strategies, or diversification techniques will shield them from major losses. But Burry often reminds people that models fail precisely when they are most needed. Before the 2008 crash, banks used advanced risk models that predicted near-zero default risk. These models failed catastrophically because they were built on false assumptions. Today, many investors rely on models that assume low volatility, stable inflation, and predictable growth. But are these assumptions valid? And more importantly, what happens if the models are wrong? Another psychological phenomenon is the seduction of growth narratives. Throughout history, investors have fallen in love with stories of technological transformation. In the 1800s, it was railroads. In the 1920s, automobiles and radio. In the late 1990s, the internet. Today, it is artificial intelligence, automation, and digital platforms. Burry acknowledges that many of these innovations are genuinely transformative. But he warns that innovation does not eliminate the laws of valuation. Growth narratives can blind investors to basic questions: how much is too much to pay for a company's earnings? How realistic are long-term growth assumptions? What if competition intensifies? What if regulation increases? Burry asks, if everyone believes AI will reshape the world, are they buying because they understand the fundamentals or because they fear being left behind? It is also crucial to examine the psychological comfort investors find in institutional reassurance. Central banks, governments, and financial institutions often present optimistic forecasts to maintain stability. Investors interpret these reassurances as evidence that risks are manageable or temporary. But Burry argues that institutions have their own incentives. They aim to prevent panic, maintain confidence, and avoid instability. Their role is not to predict downturns. Their role is to steady the public. This creates a disconnect between institutional messaging and market reality. Investors assume safety where none exists. One of the most insightful questions Burry asks is this: why do people prefer optimistic lies over uncomfortable truths? The answer lies in the emotional nature of investing. Optimism promises opportunity. Pessimism demands discipline. Optimism feels empowering. Pessimism feels restrictive. Most investors prefer to believe that markets will rise because rising markets make investing easy. The truth that cycles are inevitable, that risk compounds silently, that bubbles form gradually but burst suddenly, is unsettling. But ignoring unsettling realities does not protect investors. Instead, it exposes them to greater danger. Burry also analyzes the psychological pattern of disbelief at turning points. Before every major crash, investors dismiss warnings as exaggerated. They point to previous scares that did not materialize. They say, "This time is different." These four words, Burry argues, are the most dangerous in finance. They encourage complacency. They justify excessive risk-taking. They silence contrarian voices. When people believe that the economic environment has changed fundamentally, they abandon caution. But Burry notes that although technology and industries evolve, human psychology does not. Market cycles are driven not by innovation but by emotion. A final psychological layer shaping Burry's warnings is the concept of slow building pressure. Most investors expect crises to begin with sudden, dramatic events. But Burry argues that the most dangerous crises start quietly. They grow through small imbalances, overlooked signals, and ignored warnings. The pressure builds until one event, often minor, triggers a chain reaction. He compares this to an earthquake. The tension accumulates deep beneath the surface. No one notices until the ground starts shaking. But by then, it is too late to prepare. Financial markets operate the same way. Structural weaknesses accumulate for years. Investors adapt to risk and normalize imbalances. Then, a single shock, a rate hike, a liquidity shortage, a geopolitical event reveals how fragile the system truly is. Burry believes modern markets are in precisely this phase, calm on the surface, unstable underneath. The question investors must ask is not whether a trigger will come but when and what chain reaction it will set off. As we conclude Part 3, one theme becomes clear: Burry's warnings are not merely about numbers but about human behavior. Markets rise and fall based on psychology as much as economics. Ignoring that psychology, especially during periods of optimism, is the primary reason investors fail to see danger until it is too late. But if these psychological patterns are so well known, so historically consistent, why do investors keep repeating them? In this final chapter, we enter the most uncertain part of Burry's modern warnings, the part where predictions meet reality. It's no longer just theory, no longer just analysis, no longer just historical comparison. It's the moment where the patterns he has identified begin to collide with real-world consequences. And the question becomes painfully clear: are we already inside the crash he warned us about, or just at the very edge of it? To understand Burry's current stance, we must look at one core truth that defines him: he doesn't issue warnings lightly. His history shows that he often stays silent for long periods, disappearing from public view, only returning when he believes something is truly wrong. So when he speaks now, with urgency and repetition, it becomes impossible to ignore. But what is he warning about today? What patterns does he see beneath the noise, patterns the rest of the market continues to excuse, justify, or simply overlook? Let's begin with one of his most alarming observations: the illusion of resilience. In recent years, markets have convinced themselves of a simple narrative that new technology, new monetary tools, new investor psychology somehow make them invincible. That no matter how stretched valuations become, no matter how much debt piles up, no matter how disconnected prices are from reality, markets will always bounce back. Burry views this belief as one of the most dangerous delusions of the current era. And he's not alone. Many contrarian thinkers argue that the deepest crashes occur not when markets look weak, but when people believe they cannot fail. That was true in 1929, true in 2000, true in 2008, and perhaps true again today. Burry repeatedly highlights that markets are being held together not by genuine value, but by psychological momentum. When stocks rise simply because they're rising, and investors chase returns simply because others are chasing, the entire system becomes a self-referential loop. One that works beautifully on the way up, but collapses instantly when sentiment shifts. Which raises a critical question: what happens when confidence disappears? Because confidence always disappears eventually. Another major category of Burry's warnings involves consumption and household debt. For decades, the world relied on cheap credit to fuel economic growth. But Burry argues that this model is now collapsing under its own weight. Credit card debt is at record levels, delinquency rates continue to rise, and savings rates in many developed countries have fallen to historic lows. Meanwhile, inflation has permanently changed the cost of living, yet wages have not kept up. Burry's interpretation is stark: consumers are running on fumes. But why does this matter for markets? Because when consumers fall, corporate earnings fall. And when earnings fall, market valuations, especially massively inflated ones, can no longer be justified. Burry's warnings about corporate buybacks also serve as a critical but overlooked insight. For years, corporations have been borrowing money to buy back their own stock, artificially raising share prices and earnings per share numbers. But Burry argues that this strategy has reached its limit. Higher interest rates mean the buyback machine is slowing, and without it, the market loses one of its most powerful engines. So ask yourself, what happens when the fuel that pushed the market upward suddenly disappears? Let's also examine another one of Burry's recurring themes: the fragility of passive investing. He continues to warn that index funds and ETFs have created a new type of bubble, one that mirrors the housing crisis in structure but not in form. In the same way that mortgage-backed securities bundle toxic loans into seemingly safe products, passive investment vehicles bundle thousands of companies, good, bad, and failing, into single packages. Investors buy them blindly, without analyzing individual companies. Burry fears that this blind buying creates a market heavily distorted by flows rather than fundamentals. Now imagine what happens when money begins flowing out of these products instead of in. Does the entire structure unwind? Do weak companies collapse instantly? Do strong companies fall alongside them? These are not theoretical questions, they are structural dangers. One of Burry's most consistent traits is that he treats markets not as machines, but as organisms. He studies the psychology, incentives, and behavior patterns that drive them. And he understands something many investors ignore: systems collapse slowly, then all at once. He sees the slow phase happening right now: cracks forming in credit markets, consumer weakness, corporate fragility, speculative excess, and economic policies reliant on hope rather than sustainable principles. But what about the all-at-once phase? Has it begun? Or is it still ahead? Another essential part of Burry's current perspective involves geopolitical risk. He notes that global tensions create unpredictable supply chain disruptions, energy shocks, and inflation pressures, none of which can be controlled by central banks. Modern investors often assume governments can manage every crisis with policies, printing money, or targeted stimulus. But Burry believes the world is entering a cycle where policy tools are limited, and consequences are unavoidable. What is his final warning? What message does he want the public and the market to understand? It's this. Markets are cyclical, not linear. History repeats because human behavior repeats. And when investors forget this truth, they invite disaster. Burry doesn't want people to panic. He wants them to think. His warnings are not predictions of doom for the sake of drama. They are alerts meant to encourage rational, disciplined behavior in a world dominated by emotion and speculation. He wants people to examine value, challenge narratives, question assumptions, and resist the seductive pull of crowd psychology. And yet, the biggest question remains unresolved. Is the world listening this time? Or will his warnings, once again, be dismissed until it's too late? As this documentary concludes, reflect on one final thought. Michael Burry is not asking you to believe him. He is asking you to look. Look at the data. Look at the patterns. Look at the past. And ask yourself, what do you see coming? Because history has a habit of rewarding those who question everything and punishing those who follow blindly. This is the end of the series, but for Burry, the story is ongoing. The warnings continue. The patterns evolve. And the future, uncertain, fragile, and full of risk, has yet to reveal its truth. Thank you for watching this deep dive into Michael Burry's latest market warnings. If this documentary made you think, question, or look at the markets differently, then don't leave just yet. More powerful stories, analyses, and breakdowns are on the way. Subscribe, turn on notifications, and join our community of smart, independent thinkers. Because the next big insight might be the one that changes how you see the world. Stay curious. Stay informed. And stay ahead of the crowd.